Most small business owners don't get in trouble with the IRS because they're bad people. They get into trouble because they only think about taxes once a year, and that's usually just a few days before the deadline. Today, I'm going to show you exactly how to stay ahead of the IRS in 2026 with year-round tax planning strategies that my most successful business clients follow. Because when you get this right, you don't just reduce your taxes, you protect your business, your cash flow, and your peace of mind. Why do small business owners face the biggest IRS risks? Well, it's because business owners frankly juggle dozens of responsibilities, and taxes often fall to the bottom of the list. They often operate with incomplete records, rough estimates, or do-it-yourself bookkeeping. IRS returns have to tell a story that makes sense, and messy books trigger scrutiny. IRS audit rates for business owners are higher because their revenue fluctuates, deductions are larger, expenses can look estimated, cash flow practices aren't always documented, and often entity selection is unsophisticated. Most business owners are great at what they do, but terrible at keeping up with the IRS. The truth is, year-round tax planning keeps you out of crisis mode. Most owners do taxes backwards. They deal with everything in April. But real tax planning happens monthly and quarterly. Fixing tax problems later is always more expensive than preventing them. Let me provide you a few examples of year-round habits. You need to keep expenses documented monthly. You need to avoid round number estimates. You need to keep business and personal accounts separate, so no commingling. You can tell that's a hot button with me. You need to track your business mileage, your meals, your subcontractors, and equipment purchases. And really, you should be reviewing your taxes on a quarterly basis. The IRS has become much more data-driven lately. They already know more about you than you think. They have your W-2s, your 1099s, your mortgage interest, and records from your payment platforms such as Zelle, Venmo, and PayPal. In 2026, with new AI tools being rolled out internally, they're going to match this data even faster. Now, if the thought of keeping up with IRS rules all year long already feels overwhelming, I get it. And that's exactly why I created something called the IRS Battle Guide. It's a long-form, do-it-yourself breakdown of the real IRS processes, the traps that business owners fall into, and the exact mistakes that turn a small issue into a six-figure tax problem. Most people download it and instantly realize two things. It's a lot more complicated than they thought, and they probably shouldn't try fighting the IRS alone. You can grab it for free. I'll leave the link below. Let's talk about key strategies to stay ahead for 2026. You need to know the difference between an allowable deduction and a deduction that you shouldn't take. Many businesses pay more because they leave legitimate deductions on the table because they're afraid to take them. The key to winning the deduction battle, should it come down to an audit, is the quality of your documentation. So keep your records in a manner that you can easily store and track them. No more round number expenses. When I'm reviewing a tax return and I see your tools expenditure is exactly $15,000, I know that that's an estimate. If I know it's an estimate, what are the odds that the IRS doesn't know it's an estimate? You need to keep receipts and paid invoices even when you pay online. Just print out the receipt and store it so you can find it in the future if you need to. You need to use one bookkeeping software or accountant, not 5. I want to help you get ahead of the new 2026 tax law changes. The one big beautiful bill goes into effect in 2026, and we're still finding good stuff in this new law. The state and local tax limit, also known as SALT, increased from $10,000 to $40,000. Purchases of American-made automobiles will have an interest deduction. Opportunity funds have been made permanent, and all taxpayers can use them to kill capital gains. There's no taxes on tips, and there's other changes to deduction limits for business owners, such as retirement and healthcare related. Once the IRS technology upgrades finally hit, then there's going to be faster matching and faster enforcement of tax liabilities. There's going to be a smaller margin for bookkeeper mistakes, late filings, or sloppy records. Changes are coming, and business owners who prepare early save the most. If you thought the IRS has been bad in the past, now they have fewer employees who have much less training experience, who will be empowered with AI and other software tools to collect. That doesn't sound like a fun recipe to me. You need to act early before the IRS contacts you. The earlier a business owner gets help, the more options they have. Waiting removes leverage. Once a garnishment, levy, lien, or audit hits, it becomes 10 times harder to negotiate. Now, all of this gives you a clear picture of how to stay ahead of the IRS in 2026, but there's another issue just as important that most business owners overlook: who you rely on when something actually goes wrong. Because a CPA and a tax attorney solve completely different problems, and choosing the wrong one can cost you thousands. So before you file another return or respond to an IRS letter, make sure to watch this next video. It'll show you exactly who to call, when to call them, and how to protect yourself before things escalate.